I'm delighted to welcome all of you this morning to the annual general meeting of shareholders of IVE Group. It's now 14 minutes past 10, and joining me today is our Group CEO, Matt Aitken, our directors, Gavin Bell, Kathy Aston, Paul Selig, Andrew Bird, Sandra Hook, and James Todd. Also joining us is our CFO, Darren Dunkley, and representatives of the audit team at KPMG. So welcome everybody this morning, and presumably we all have our mobile phones off. Before handing over to Matt for the CEO's address, I just have a few remarks to make. Both my document and Matt's document have been posted on the ASX this morning, but essentially we will be following those two documents through the course of the meeting before we get to the formal part of the meeting. Reflecting on the company's performance and resilience through the COVID-19 pandemic, I wrote in our 2021 annual report, as I reflect on the extraordinary year we've had, this coinciding also with our centenary as a business, it has reaffirmed my optimism that as we emerge from the pandemic, the solid fundamentals of our business place IVE in a position of strength from which to continue to grow and evolve over the years ahead. In that context, our board is delighted with the group's performance over the last 12 months, a year that was a record year for the company. We delivered our second year of solid uplift in both revenue and earnings since the pandemic. And the result is even more pleasing given trading conditions over the period were not without challenge, with margins pressured by input price inflation, coupled with materially higher energy costs and finance costs. I don't have it on the screen, but just as a snapshot, speaking specifically to that uptick over the last 2 years since the pandemic, if you looked at FY22 over FY21, our revenue was up 15.6%, our EBITDA was up 13.3%, NPAT up 66%, and EPS up 71.1%. If you then looked at the year we just reported on, F23 over F22, we had a further increase of 27.5% in revenue, 23.1% in EBITDA, 19.8% in NPAT, and 14.5% in EPS. So I think those metrics absolutely validate my quote from the 21 annual report and reaffirm the solid fundamentals of the business. Matt will talk more specifically to some of the metrics in his presentation. We had a significant event in September of last year. Following the ACCC's clearance, we completed the acquisition of a major competitor of ours in the print sector called Avato. Once that integration is complete, the acquisition is expected to deliver annual revenues of 145 million, 25 million of EBITDA and $13 million of NPAT. Matt will talk more specifically to Avato in his presentation, including an update on the integration program and where we're up to. Allowing for the modest capital raising that we completed in October of 2022, as I said previously, earnings per share increased 15% over the period, supporting a full year dividend of 18 cents per share fully franked. The current year payout ratio of 69% is consistent with the company's dividend policy, which targets a full year payout ratio of 65 to 75% of underlying NPAT. Since listing on the ASX in December 2015, and inclusive of the dividend, the last dividend declared, the company's paid $1.03 per share in fully franked dividends, representing a total payout of $143 million, which is an average of 70% of our payout ratio since we listed. And this is consistent with both the profitability and the cash generative nature of the IVE business. And those metrics I just read out exclude FY20, when the company prudently elected not to pay a dividend as a result of the COVID-19 pandemic. The company remains well capitalised and highly liquid. Our balance sheet is strong, with net debt of $124 million at 30 June 2023, up from $76.8 million a year ago, which equates to 1x EBITDA or 1.4 times pre-AASB 16 EBITDA, which is below our stated target of 1.5 times pre-AASB 16 EBITDA. And it's important to note that the group's net debt position increased over the year primarily as a result of the Avato transaction and associated integration costs, and essentially the need to hold additional inventories or increase our working capital, given the significantly increased size of the IVE business. To better manage increasingly volatile energy costs, both electricity and gas, which we've well documented over the last few years, and consistent with stakeholder expectations for the business to transition to 100% renewable, we executed a 7-year partnership agreement in April of this year with Iberdrola, one of the world's largest renewable energy companies. From January 24, IVE's electricity requirements will be generated from a renewable source, primarily wind, creating a clear pathway to 100% renewable supply. With respect to ESG more broadly, Matt will cover this in his part of the presentations this morning. As a business, we've successfully executed over the last decade or more on our strategy of growth and diversification. Core to this has seen the company successfully move into a number of natural adjacencies, often through an initial cornerstone acquisition. More recently, and following an in-depth analysis of the Australian packaging sector, we determined for a number of reasons that the $800 million plus folded cartons or fibre-based cartons segment was strategically attractive adjacency for the group to pursue. And consistent with other product adjacencies in which IVE operate, the shorter run folded carton segment thematics are appealing and afford IVE the opportunity to play a lead role in consolidating a fragmented market by way of a cornerstone acquisition. This is a strategy that's played out for us many times over the last 10 to 15 years. Following on from that, in October 25, just last month, the group entered the fibre-based packaging sector through the strategic acquisition of a leading Melbourne-based packaging business called JakPak. This cornerstone acquisition provides a very solid foundation from which to grow our packaging revenues over the years ahead. And whilst the group may consider opportunistic bolt-on acquisitions moving forward, the primary driver of our growth strategy, which Matt will cover in his presentation, will be organic. And we look forward to providing a more comprehensive update on our packaging strategy in February next year at the time of our interim results. In conclusion, I'd like to extend my sincere thanks to our Group CEO, Matt Aitken, for his ongoing commitment and outstanding leadership of our business. Our cohesive and talented leadership team, Darren Dunkley, our CFO, who I mentioned before, our divisional CEOs, Cliff Brigstock, Sean Smith, Darryl Meyer, Michael Bettridge, Rob Draper. We have a wonderful team of people leading the business, and at a middle management level. I would also like to extend my thanks to our 2,000 plus dedicated staff for their wonderful efforts throughout the year. Thank you also to our fellow directors, Paul, James, Sandra, Gavin, Kathy and Andrew, for your ongoing contribution, expertise and support. In addition to the continued optimisation of the group's operating assets, the business remains committed to its previously articulated diversification and growth strategy. The company's bounced back strongly from COVID with a strengthened market position. We are match fit, our balance sheet remains solid, and we have a team focused on delivering across a range of initiatives over the year ahead to further drive the ongoing strength and sustainability of our business. So thank you very much, welcome, and I will now hand over to our Group CEO, Aitken, for the CEO's report.
Thank you, Geoff. Good morning, everyone. It's my pleasure to present to you this morning. My name is Aitken. I'm the Group CEO of IVE Group. In my presentation today, I'll recap the FY23 results, provide a number of operational updates and talk about the year ahead in terms of both growth initiatives, FY24 trading update and outlook. And some of the content will already be familiar to some of you as we covered it in the release of our full year results only 12 weeks ago. So I'll move through those sections quickly and focus more on the operational updates, the growth initiatives and the outlook. Just start with the financial highlights to start with. As you can see from the dashboard here, we had a record year for revenue, EBITDA, NPAT, and a strong increase in dividends through the year, and strong increase in EPS as well. So revenue was $967 million, up 27% on PCP. EBITDA up 23.1% on PCP, and NPAT up 19.8% on PCP. Organic growth revenue was 6.2%. Return on funds employed increased to 24.7% from 21.3%, and our balance sheet, as Geoff referenced earlier, remained strong with debt at 1.4 times pre-AASB 16 EBITDA versus our 1.5 times target. From an operational perspective and in terms of key highlights, we executed on the Avado acquisition in September 2022, and I'll provide an integration update on that acquisition in the coming slides. We completed a $19.3 million capital raising, comprising almost 8.6 million shares at $2.25 per share in October 22. And also in October 22, we successfully launched our e-commerce marketplace, Lasoo, and we also finalised and implemented our 2025 and beyond ESG strategy. During the year, I've initiated a number of growth strategies, being investment into the expanded content creation strategy, leveraging our core business capabilities and our growing apparel experience to expand our corporate uniforms business, and completing our foreshadowed entry into the fibre-based packaging sector with the cornerstone acquisition of JackPak in October 2023. And again, I'll cover these three initiatives in more detail as I get through my presentation. As I mentioned earlier, in relation to the Avado acquisition, we completed this acquisition in September 22. The integration of the Avado assets and revenue transfer into IVE's existing operations has progressed very well, delivering meaningful synergies from leveraging the group's operating assets and cost base. Notwithstanding the significant FY24 costs we continue to incur from running Avado's New South Wales site here at Warwick Farm in Sydney, as we progressively wind that site down ahead of the final exit. Integration is now expected to be completed by the end of calendar 2023, some 5 weeks away, 6 months ahead of original plans and further expedited since the release of our FY23 result in August. The expedited final phase of the integration reduces operational risk and frees up management to focus on the go forward. The acquisition, as Geoff said, is highly earnings accretive, delivering $145 million in revenue, $25 million in EBITDA, and $13 million in NPAT in FY25. And notwithstanding the financial metrics of the transaction, we've also ended up with many fantastic staff and new customers as a result of this acquisition. And the management team responsible for the integration have been extremely diligent in their approach over the last 15 months and have done a fantastic job in completing the integration ahead of schedule. In relation to Lasoo, some of you would be aware that we acquired Lasoo in 2020, in January 2020, but it was actually established in 2007. In FY22, the group invested to transform Lasoo into an e-commerce marketplace for retailer specials, with the new platform launched in October 22. Independent feedback on both the platform user experience and consumer shopping experience has been pleasing, and is illustrated more clearly by the two charts on the top right-hand corner of this slide. And we continue to experience strong retailer uptake, with more than 170 retailers now fully integrated onto the platform. And as you can also see, we still have a healthy pipeline of retailers coming into the platform as we look out over the next 12 months. Appliances Online went live recently, joining the likes of Barbecues Galore, Carlton United Breweries, Lincraft, Autobarn, Shields, Bevels, and Direct Chemist Outlet, and many more Australia's best-known brands, is providing exclusive deals to the Lasoo marketplace only. Since the launch of Lasoo, we've continued to deliver strong month-on-month growth, consecutive month-on-month growth. Key financial metrics, including monthly active users, conversion rate, average basket size, gross transaction value, and commission rates, are all tracking in line with or above the business case expectations that we set. The growth trend in monthly active users is encouraging, as are Lasoo's diverse customer demographics, and the two charts on the top right of this page provide further insight into these metrics. Conversion rates and the average basket size are performing above expectations, with Lasoo's average basket size currently $172 compared to the business case of $120. And this reflects strong sales in the higher value categories. And again, you can see a split of sales by category in the pie chart on the bottom right of this page. Lasoo is expected to generate annualised gross transaction value, GTV, of $15 million by June 2024, and that is 64% above the original business case, and on current trajectory, it's expected to break even during FY26. And based on the current momentum and better than expected marketplace performance, we are now reviewing various growth options, and will provide a further update to investors when we release our H1 results in February 2024. Turning now to the growth initiatives in front of us, and starting with our expansion into the content and creation offering. Today, we include more than 80 creative staff across Sydney and Melbourne, including staff embedded within client sites, working across a range of sectors, including banking and financial services, FMCG, grocery, retail, property, and luxury brands. The team has strong foundations in creating marketing collateral for both digital and physical mediums that IVE produces, distributes, and activates in the market. However, the division is arguably underrepresented relative to the market position and customer penetration of many of the group's other businesses. The media landscape continues to fragment, and the proliferation of channels has significantly increased the type, volume, and frequency of content that needs to be produced to ensure effective omni-channel marketing. We view this as a further opportunity to support customers and leverage the group's unique idea to execution market position by developing a deeper and more comprehensive go-to-market content creation offering over the next 24 months through expanding the breadth and depth of the group's creative services, content production and marketing technology business, protecting and leveraging existing relationships by introducing new and highly valued services and solutions to existing clients, and entering new markets and developing profitable revenue streams through bundling these new capabilities and existing services to a broader customer base. And by doing this, we will continue to advance IVE's holistic offering of data-driven, content-rich, omni-channel marketing services to our customers. In relation to apparels and uniforms, having developed a garment sourcing capability in IVE's premiums and merchandising business over recent years, apparel and corporate uniforms is a natural and growing product adjacency for us to enter. The Australian corporate uniform market is estimated to be at $1.2 billion in size and growing at 5% per annum. It is underpinned by general wear and tear, as well as staff attrition, which is typically higher in uniform roles in Australia. And although a relative newcomer to the market, IVE has a unique service proposition. We have an extensive client base, 2,800 customers, with a material recurring uniform spend within that client base. We understand our customers' brands and how to creatively execute across a range of mediums, including apparel. Our ability to leverage our scale to disrupt existing pricing structures. We have established onshore and offshore sourcing expertise, We have established national warehousing distribution capabilities. We have the capital and resources to build our own team, and we have strong ESG sourcing credentials and innovative ideas around sustainability with respect to the life cycle of uniforms once they are no longer worn by an employee. The current apparel and corporate uniform clients include all security staff at Sydney and Adelaide airports, so that's for a company called Surface, Sydney trained security staff, Surf Lifesaving New South Wales, IAG, Tabcorp, some areas now CommBank, and more recently the plumbing and bathroom company Reece, as we roll out all Reece branded merchandise and apparel for all tradies across Australia and New Zealand in the coming months. The group currently has a strong pipeline of opportunities as well. We've got several promising trials in play, and we're awaiting the outcome of a number of RFPs. Moving on to packaging, over the last 18 months, some of you would be aware we've completed an in-depth analysis of the packaging industry to identify a pathway to establishing a packaging business that has the potential to generate revenues of $150 million in the next 3 to 5 years. It's also important that it provides sustainable returns, has ongoing growth prospects, and is aligned with our sustainability agenda and unlocks synergies from within our existing business. The higher margin, shorter run folding carton segment was identified as the initial target. It's an $800 million segment that grew at 10% last year and offers sustainable returns and strong growth prospects. Folding cartons make up a large percentage of the preferred packaging format for food, beverage, cosmetic and wellness customers, with overlap with IVE's existing customer base. The segment offers strong synergies complementing IVE's printing and logistics capabilities, and carton board sustainability credentials are sound. Consistent with other product adjacencies in which IVE operate, the folding carton segment presents IVE with an opportunity to play a lead role in consolidating a highly fragmented market by way of the Cornerstone acquisition, supplemented by bolt-on acquisitions and organic growth initiatives. And the chart on the right-hand side illustrates the market share and the fragmentation of the folding carton market. And you can see with the JackPack acquisition where we sit in that market share. As Geoff mentioned earlier, on the 25th of October 2023, we entered the packaging sector with the Cornerstone acquisition of JackPack. JackPack is a leading Melbourne-based player in the short to medium run length folding carton segment with annual revenue of $45 million. The total purchase consideration for JackPack was $35 million, $27.9 million payable in completion, $4 million payable on deferred consideration based on hurdles being met over the next 12 months, and the assumption of $3 million of equipment finance leases. The purchase consideration payable at completion was cash funded, and the acquisition is expected to be EPS accretive in FY24. By the end of FY24, we expect to unlock annual synergies of $2.4 million, and following the realisation of synergies, the business will contribute EBITDA of $8.4 million and NPAT of $3 million, delivering EPS accretion of 7%. This represents a 4.2 times EBITDA multiple on the $35 million purchase consideration. JackPack currently has $15 million of available capacity for organic revenue growth. Over the near term, we are confident of utilising that capacity through new or expanded customer relationships, which would increase JackPack's contribution to revenue of $60 million, EBITDA of $11.9 million, and NPAT of $5.5 million. So inclusive of synergies and assuming current available revenue capacity is utilised, this would represent a 2.9 times EBITDA multiple on the $35 million purchase consideration. The acquisition of JackPack, and as we look ahead in terms of our growth strategy, the acquisition of JackPack provides a solid foundation from which to grow our packaging revenues over the years ahead. And whilst the group may consider opportunistic bolt-on acquisitions, the primary driver for our growth strategy will be organic. The versatility of our equipment profile is core to our strategy. By that, I mean the printing equipment required for the production of folding carton packaging is similar to the equipment IVE currently operates across our existing Victorian and New South Wales commercial printing sites today. And to produce folded carton packaging, we only need additional die cutting and gluing equipment. Consistent with the group's existing footprint, IVE intends to service national brands through the packaging operations in both Victoria and New South Wales, supported by our national network of logistics hubs to ensure the storage and timely distribution of finished packaging goods. In Victoria, JackPack will continue to operate as a standalone business with a capacity to generate $60 million of annual packaging revenue. In New South Wales, we intend leveraging the operational footprint of the group's printing operation here in Silverwater and Sydney by expanding the site's capability to also support the efficient production of folded carton revenue. And you can see both on this page and the prior page the profile of customers and the work that JakPak produces. Some of those images there, they are all JakPak customers today, and gives you a feel for the product profile that we're talking about. From an ESG perspective, we're about leading change for a brighter future. The group has always had a very strong environmental credentials and sustainability initiatives, and they've always been top of mind for many years. Over the last 18 months, we've worked with specialist advisory firms to design and implement a strategy and framework that will guide our ESG strategy in the years ahead. The project involved 4 key stages, which we're developing the evidence base to inform our strategy, identifying the most material issues relevant to our business and how we will strategically address these issues, developing our goals and initiatives that will support our strategy, and delivering the finance sustainability strategy and activating that to all key stakeholders. It's important to the board and the management team that the plan we develop is real and that it serves all of our key stakeholders and that we can execute on it. And so our strategy for 2025 and beyond has 3 core pillars: designing innovative customer solutions to push the boundaries of sustainable product development in our sector and empower customers with the knowledge of making informed choices, valuing our people and communities to continue creating a safe and inclusive working environment and supporting those communities who support us, maintaining responsible sourcing operations and supply chains and to mitigate our impact on the climate and lead projects that deliver more regenerative and ethical supply chains. And as some of you would be aware, and Geoff touched on, we signed an agreement with Iberdrola to move all of our electricity to a renewable wind farm source from 1 January 2024 as we stage into 100% renewable energy between here and 2030. And underpinning our approach is our ongoing commitment to transparency and authenticity through disclosure and governance. Just finishing with a trading update and outlook. So notwithstanding the prevailing economic uncertainty, the business performed solidly over the first 4 months to 31 October 2023. Revenue is broadly in line with a very strong PCP, excluding incremental Avato revenue. Material gross margin is up slightly on PCP, and EBITDA, an EBITDA of 41.2 million compared with 39.5 million PCP, and that includes the impact of higher electricity and gas costs relative to PCP. Today, IVE reaffirms the FY24 underlying earnings guidance range provided on the 24th of August, that being EBITDA of 122 to 127 million, EBIT of 74 million to 79 million, and NPAT of 40 million to 43 million. This guidance is on average an increase of between 3% at the lower end of the range and 8% at the top end of the range on our FY23 results. Noting the following items are excluded from the guidance: any contribution from JakPak, the after-tax loss on Lasoo of $3.9 million, which reflects an expected 20% improvement in EBITDA over FY23 and is consistent with the number we've published previously, and restructure and integration costs of $12.5 million. Capital expenditure is still expected to be $14 million, and that excludes $4.5 million of Avato integration CapEx. And excluding additional financing costs associated with the JakPak acquisition, net finance costs are expected to be around $17 million, and that comprises $9.5 million net relating to corporate debt and $7.5 million relating to leases, including non-cash impacts of AASB 16. So net debt at 30 June 24 is expected to be broadly in line with the company's stated target of 1.5 times pre-AASB 16 EBITDA. Finally, I'd like to say thank you to the leadership team and the 2,000 staff for their ongoing commitment and dedication to our customers and the business, and to Geoff and the board for their ongoing combined support. Thank you very much. I'll now hand back to Geoff.